Donald Trump has once again intensified his rhetoric on imposing severe tariffs on Canada and Mexico, declaring on Monday that the proposed 25% levies remain on schedule for implementation on March 4th. The potential consequences of these tariffs have raised significant concerns, with economists warning that a prolonged trade war could plunge Canada into a recession. Despite Trump's strong stance, even he has his weaknesses, or what might be termed his kryptonite. According to Benjamin Tal, Deputy Chief Economist at CIBC World Markets Inc., there are key factors that could force the former president to reconsider his aggressive tariff agenda. The stock market reaction. One of Trump's most notable vulnerabilities is the stock market. The former president has frequently pointed to stock market performance as a measure of his economic success. Any significant downturn in the markets could pressure him to backtrack on his tariff plans. Earlier this month, U.S. stocks took a hit on February 3rd, the initial deadline for the tariff implementation. However, when Trump announced a 30-day delay, markets rebounded, demonstrating the direct impact of his trade policies on investor confidence. It's not a surprise that Canada and Mexico were granted 30-day extensions on the 25% tariff. Shortly after the stock market reacted negatively to the news, said Tal in a note last week. The stock market has remained relatively strong since then, not necessarily because investors believe tariffs are beneficial, but rather because they assume Trump would avoid policies that could significantly harm market sentiment. Should stock market volatility increase or a major sell-off occur, Trump may be forced to reconsider the economic risks tied to his trade agenda. Rising gas prices. Another major factor that could undermine Trump's tariff ambitions is the price of gasoline. Trump has consistently championed energy independence with his "drill, baby, drill" mantra, emphasizing his desire to keep fuel prices low for American consumers. However, the tariffs he proposes could have the opposite effect. If Trump proceeds with a 10% tariff on Canadian crude oil, American consumers would see an immediate increase in gasoline prices at the pump. Canada is a crucial supplier of oil to the US, and there is no immediate substitute for Canadian crude. Higher oil prices would likely trigger public backlash, a scenario Trump would want to avoid. We doubt that even a 10% tariff on energy will be imposed, said Tal. Ironically, Trump renewed his push on Monday for the Keystone XL pipeline, urging its construction now. The pipeline, which was initially designed to transport oil from Canada's oil sands to Nebraska, had been abandoned after facing legal and environmental challenges. Trump recently claimed that America could do without Canadian oil, yet his renewed enthusiasm for Keystone XL contradicts his push for energy independence without Canadian imports. Inflation and the Federal Reserve. During his campaign and presidency, Trump often expressed concerns about inflation, positioning himself as an advocate for lower consumer prices. However, imposing tariffs on imports from Canada and Mexico contradicts this goal, as higher import taxes would inevitably lead to higher consumer costs. Even the Federal Reserve acknowledged the inflationary risks of tariffs at its January meeting. The minutes from the meeting indicated that Fed members were concerned about Trump's trade policies, hindering disinflation efforts. Business contacts in a number of districts had indicated that firms would attempt to pass on to consumers higher input costs arising from potential tariffs. The minutes read, "A surge in inflation could push the Fed to raise interest rates, an outcome that would directly counter Trump's repeated demands for lower rates. Higher interest rates could slow economic growth and increase borrowing costs for consumers and businesses alike." A direct clash between Trump and the Federal Reserve could create even more uncertainty in the markets, a situation that investors, and Trump himself, would rather avoid. The timing of the tariffs and the upcoming elections. Timing is another critical factor that could weaken Trump's tariff plans. While the long-term effects of tariffs can be debated, there is little question that their immediate economic impact would be negative. By the time the midterm elections approach, American voters would primarily experience the disruptive effects of tariffs through higher inflation, job losses, and economic instability. Many industries reliant on Canadian and Mexican imports would face increased costs, potentially leading to layoffs or reduced consumer spending. That while some form of trade penalty is likely inevitable if Trump wants to maintain credibility with his base, his kryptonite will ensure that any upcoming tariffs are less severe than feared. Whether the measures are limited in scope, duration, or magnitude, the economic and political pressures surrounding Trump's trade policies could ultimately force him to scale back his initial threats. The broader economic and political implications beyond these four vulnerabilities, several other economic and political considerations, could shape Trump's approach to tariffs. Impact on key industries. Sectors such as auto manufacturing, agriculture, and technology rely heavily on imports from Canada and Mexico. Tariffs would disrupt supply chains and increase costs for American businesses. Reactions from trade partners. Canada and Mexico have already signaled their intent to retaliate with counter tariffs, which could further escalate the trade dispute. Public sentiment. If consumers begin to feel the direct effects of higher prices, Trump's approval ratings could suffer. Given his focus on maintaining a strong base, he may adjust his policies accordingly. Congressional resistance. While Trump has significant executive authority over trade policy, opposition from lawmakers, including some within his own party, could limit his ability to enact broad tariffs. Conclusion. Trump's tariff threats may appear resolute, but they are far from immune to economic and political realities. The stock market's reaction, rising gas prices, inflation concerns, and election timing all serve as significant obstacles that could force him to modify or even abandon his plans. While Trump has successfully leveraged trade policy as a political tool, the broader implications of tariffs on the U.S. economy could prove too damaging to ignore. As the March 4 deadline approaches, investors, businesses, and policymakers will be closely watching to see whether Trump's kryptonite ultimately curtails his aggressive trade agenda.